Welcome to Intermediate Accounting, Chapter 4. This is going to be in 3 videos. We're going to talk about the income statement, then we're going to talk about the comprehensive income, and then we will finish up with the statement of cash flows. So let's just look at a little recap of what each of those are from what you've learned in financial accounting. So the income statement, also known as profit and loss or the P&L, that is going to look at a period of time and it's going to show the company's profit during that particular time. So it's going to show their net income based on revenue minus expenses. Then when we get to comprehensive income, it's not only going to show the amount of revenue minus expenses, but it's also going to include some other gains and losses. So we're going to dig into what the difference between the income statement is and the comprehensive income statement and see how those differ in the second video. Then we have the statement of cash flows. This one's kind of tricky. It is going to provide information about cash coming in and cash going out. That sounds super similar to the income statement, and it may be, but due to accrual accounting, it is going to have possibly some drastic differences. So make sure you watch the third video I'm going to make on this chapter covering the statement of cash flows. All right, so let's first look at the income statement. This is an example. I took this from Amazon.com. This was their end of year for 2024, and that's compared to 2023. And you can pull this information. It's public because they are a public company. So as you can see, they have their income from continuing operations. They have their sales revenue. And as you see at the top, this is in millions. And as I mentioned before, when it's in millions, that means they've just dropped 6 figures from behind it. So this number is actually $376 billion, almost $378 billion in sales revenue for 2024. So they've dropped the 6 figures behind it. Then we've got our cost of goods sold. So hopefully that rings a bell, but that is where they have paid for inventory. We know that that's what Amazon does. They primarily make their money from selling goods. So they have cost of goods sold. That was the cost they paid for all of the inventory compared to what you and I paid when we ordered Amazon packages. The difference between the two is the gross profit. As you can see, now you would only see this on a company that sells merchandise. If it's a service company, you would not see the gross profit because they're not going to have any cost of goods sold. So it would just be the service revenue minus any operating expenses. But since Amazon has lots of goods that they sell, we are going to see them as a merchandise company, and we're going to see it broken out in that way. Then we have the operating expenses. So this is going to be everything else that was not included in that cost of goods sold and that inventory cost. So you're going to have selling expenses, general administrative, and then on their public financial statement, they just list other operating expenses. So we know included in that are going to be things like salaries, and there's going to be depreciation and all kinds of other things, but they don't go as into detail when they show the public financial statements. And you can compare how that looks from one year to the next. Looks like they have more in operating expenses in 2024, but they also have much more in revenue as well, close to $100 billion more from 2023 over to 2024. Then we're going to see some other income. We've got some interest revenue and interest expense. Remember, those parentheses are going to show when it's a negative number, and they have some gains and losses as well. And then you'll see at the bottom here, they have their earnings per share. We are going to start with talking about earnings per share in the second video in this chapter and how that is calculated. Okay, so we know with the income statement, we have revenue minus expenses. That equals net income. Super easy formula there. Net income shows us what that final profit is. So when we have revenue, that is going to be earned as a result of our sale of good or services that we have provided. This is not where owners have put money into the company. This is regular business operations. And then our expenses are going to be all of those costs that we had in order to get that revenue. So this is going to be, again, those salaries, general and administrative expenses. It's going to be depreciation, lots of different expenses we'll see there. It could be even postage and rent, all of that good stuff. So then we also will see, usually below it, we'll see gains, which is going to come from some kind of outside activity that is not the normal business operations. This is not a gain because we sell hairbrushes and we paid $4 for it and we sold it for $6, so we had a $2 gain. No, that's going to be our gross profit from our revenue minus cost of goods sold. Gains are coming from some other kind of activity, like selling a building, perhaps. Or here in this example, a company sells a piece of equipment for $10,000. They originally paid $7,000 for it, and that $3,000 difference is the gain. And then losses, obviously the other side of that. So again, this is not going to be normal business operations. This is going to be something outside of that. So if the company sold a vehicle for $5,000, they paid $8,000 for it, that $3,000 difference is a loss here. And depreciation would be taken into account, but maybe in this case, they have no time has passed and they just sold it immediately and didn't actually experience any depreciation. So we do list those separately because we want to make sure that people can tell the difference between the regular operations, income and expenses versus things that are outside of that normal. So we typically see it that way. But then we do have two different options. You'll typically see the multiple step income statement, which we're going to look at second, but this single step income statement actually puts all revenue and gains first. So it does put the gains along with the revenue, and then it puts all the losses along with the expenses. Not typically the way we see things done, but this is an option. So see, for Amazon, if they had done it this way, it would show their sales revenue of the $638 billion, and then they would show that interest revenue that's really outside of their normal business operations for the $4.6 billion. Then they list all the expenses and losses. So they show their net income with those all grouped together. So this is the single step option. Not what people typically choose or companies typically choose to use. What we typically see is this multiple step, which is what we just saw a minute ago, where they're going to list the revenue minus cost of goods sold, then list operating expenses, then they're going to list out any other kind of gain or losses separately so that the reader of the financial statements will be able to say, okay, this is ongoing, and then there's some one-off things, or maybe they sold a vehicle or building or something along those lines. Either way, the income, you can look back at it, ends up being the same, $59 billion in both situations. So it's the same either way. It's just which way the company would like to present it. So we also have something that's really important with accrual accounting, and that's income smoothing. That's why I put these smooth rocks in the pictures. So this is an adjustment of the financial statement so that they can present a very consistent, stable trend of earnings over time. So it's going to help where it doesn't look like the profits are so volatile, and it will help meet the earnings expectations. This doesn't mean that they are skewing the numbers or anything like that. This is looking at taking an expense that maybe we paid for all at once, but it's actually going to bring us benefit for months and months and months, and it is smoothing that over time. So that's where we get that accrual basis accounting, because we want it to be truthful of what the activity actually was and not just when we paid the cash out. So deferring revenue or expenses would be part of that. Adjusting depreciation or amortization. So we want to make sure that we're not just saying, oh, we didn't depreciate this asset over time. Instead, we just showed it as value that we paid for it, the historical cost, and then whenever we sold it, it was a big jump. No, we depreciate it over time so we can show that we're using it, and it's one even expense if you use straight line, or you can use accelerated methods, but it helps us to smooth that expense over the life of that asset. Or if it's a prepaid expense, okay, I paid $10,000 for insurance in January, and I'm going to be using this for, let's say, 6 months. I don't want to just show that $10,000 as an expense in January. Instead, I'm going to smooth that over time and divide the $10,000 by 6 months. So is it legal? Because as you hear, okay, it's reducing the perceived volatility. It helps meet earnings expectations. So that starts to make you kind of turn your head. But it is as long as you are using the GAAP approved methods, like the depreciation, prepaid expenses, as long as you're using those methods that GAAP approves. Of course, if it's a misrepresentation and we're just trying to make it look like what we want it to and use illegal accounting, then that would not be approved. But we can do so in a way that does represent it truly and is within GAAP's methods. All right, so income statement, some unusual items that you don't typically see. We have asset impairment. So there are some assets that we say, oh, we just put that at the historical cost on the balance sheet and it always stays that way. But there is a possibility that there could be some impairment to that. Maybe it is land and it now has a sinkhole in it, or it is a building and something major happened like a fire to a major part of the building. That would significantly impair the value of it. So at that point, we could go in and consider expensing out that difference. That can also happen with intangible assets. A good example of that is goodwill. Remember, goodwill is going to show up on the balance sheet as an intangible asset only when one company buys another. So it's going to be that extra that they paid on top of the net asset value. Well, if that's bringing them value, it's great. But maybe years down the line, they're like, you know what, we didn't do a great job at keeping this company up, or something bad happened with it. And the goodwill, the value of that's really not there anymore. So we'd be testing that for impairment. And they do that annually so that they could see whether or not they need to expense some of that out as a loss if they did have a significant impairment. Then we also have revenue issues that affect earnings. So a company loses a major customer that can't be replaced. So we talked about this some with the full disclosure principle in the last chapter, but it is really important for us to disclose any customers that make up a 10% or more of our revenue. So we need to make it very clear that if we've lost a customer like that, that we may not be able to replace them, and it is going to affect our earnings going forward. I want to talk a little bit about discontinued operations. So this is where a business has multiple very distinct operations. It could be different geographical regions. It could be that it is a company that, let's say it's an exercise equipment company. They sell exercise equipment, but then they also have their own gym that has some memberships. So they may have those as very distinct, and they keep the financial statements separate on this. And if one of those were to discontinue, then maybe it's shut down or it's sold, then it needs to be recognized and shown to the readers of the financial statements. So it needs to be shown separately from the regular operations. Okay, we need to let everybody know that this department is closing down, this location's closing down. We need to put that separately on the income statement. And if there's any gains or losses because of that, we need to make sure that we report those as well. But again, we want to do it separately so that it makes it very clear. We want to make sure the users are able to assess the future earnings more accurately. It really helps to improve transparency and comparability to what has been going on in the past with the company, what's happening currently, and what the future will look like. So it's really important for a company to report if there is a discontinued operation. So we're going to look at an example. Lots of words on this one, but let's go through it together. In September 2026, management of FitTime Inc. decided to sell one of its divisions, which qualifies as a separate component under GAAP. The division was sold on December 18th of 2026. Consider the following facts related to the division. From January 1st through the disposal, so all the way from January 1st of 2026 to December 18th, the division had a pre-tax loss from operations of $5 million. That is a big loss. No wonder they're discontinuing this division. The assets of the division had a net selling price of $15 million and book value of $12 million. FitTime's income statement for 2026, beginning after tax income from continuing operations was $20 million. Okay, so let's break down what is going on here and what their income statement should look like. So income from continuing operations was the $20 million. Then we want to separately show the discontinued operations. Now we're showing a $2 million loss, and the reason for that is they said they had a loss of $5 million, but then they also had a gain of $3 million from the disposal of the assets because they were able to sell them for $15 million and their book value was only $12 million, so they had a gain. So those two net out to be a loss of $2 million. Then the income tax benefit of that, since there was a loss of $2 million, we take the $2 million times 0.35, 35%, and that gives us a $700,000 income tax benefit from the loss. So it nets out to be a loss of $1.3 million from this discontinued operations. So at first we're like, they lost $5 million. Oh, but they did gain $3 million getting rid of the assets. And we do get a tax benefit for a loss, so it nets out to be $1.3 million. So when we take the $20 million from our continuing operations minus the net amount of 1.3, our loss, we end up with net income of $18.7 million. So we made sure to list it separately so the readers of the financial statements can very clearly see what is going on here. So reporting on the discontinued operations when the component is held for sale. So when the discontinued component has not been sold when the reporting period ends, the income effects are reported but modified. So in other words, in that last example, they had already sold the assets, they had already discontinued it, but here it's held for sale. They know it's discontinued, they know that's what they're going to do, but they haven't sold it yet. So they're just going to show an impairment loss. If the fair value of the assets of the discontinued component minus the cost to sell it is less than the book value. So this is where they have not sold it, so they're not super clear on what it's going to end up being, but they need to go ahead and show the loss in the year that they have decided to discontinue these operations. All right, we're going to look at accounting changes before we finish up this video. So we have 3 different kinds. We're really only going to focus on a couple of them in this video, and you really only focus on those in intermediate accounting. So they're categorized between accounting principle changes, accounting estimate changes, and then reporting entity when the company is actually acquired by another company. That's the one we really don't focus on in here because it really is just acquiring their financial statements. We will also talk a little bit about when there's a correction of errors, and that is shown up in an accounting change as well. So first, let's look at a change in accounting principle. Now, this is changing from one generally accepted accounting principle to another. This could be because it was mandatory and GAAP said, you know what, we're making this change across the board. Everyone must change this because our principle has changed. Or more often than not, it's voluntary. So it could be a voluntary change from one accepted principle to another. So when this happens, it is going to preferably be retrospectively reported. So we are going to report this all the way as far back as we can. We will make this change. So if they decide to change their inventory method, they need to go back and actually change the financial statements from the past if we would have been using that inventory method all along. Luckily, we don't get into it too much in this chapter. In Intermediate 2, you're actually going to dig into it and really be doing the work of making that change. But here we just cover the idea of it. That's the way it is with a lot of the things here. Now, prospective is if we really cannot go back retrospectively, and prospective means we're going to change this year and the years going forward. And we can only change that time on the financial statements. A change in accounting estimate. So this is where we are changing, typically it's going to be depreciation. Okay, all of these are estimates. We thought it was going to last for 10 years. It's really only going to last for 8. Or we thought it was going to be worth $5,000 at the end. It's actually going to be worth only $2,000. So that would be a change in estimate. Warranty expense. We've been estimating it would be 2% of sales. That would be our warranty expense. So we've been doing that liability. We've been creating that. But now we realize it's actually going to be more like 3% as time has gone on. Bad debt expense. You know, we have to have the allowance for bad debt accounts when it comes to accounts receivable. Again, it's all an estimate. If we have changes in that estimate and we have new knowledge, then we are going to make a change in accounting estimate. Thankfully, the estimates are changed prospectively. We don't have to go back and change anything from the past. It is understood by the reader that it was an estimate and it's not going to be perfect. Now that we have more information and we know a better percentage that we need to use, we will change it this year and going forward. So that's prospective changes. We don't have to go back retrospectively, thankfully, under changing of an accounting estimate. Again, you'll get way more into this in intermediate accounting too. And then finally, we'll look at the correction of errors. So we're all human. We've all made mistakes. And trust me, when you're working the accounting field, you will make mistakes as well. There are a lot of internal controls to try to prevent that from happening, but it is bound to happen. I have an accounting student right now who was finishing up, about to graduate, and he got his first job in accounting, and we started talking about accounting errors and really going into how to change those. And he realized, wow, yes, I have made so many errors. Luckily, we caught them all very quickly. But if they are not discovered until the next year, that makes it really challenging. So errors that are discovered in the same year, that we just make a journal entry to reverse it. It makes it very simple. Nothing has been reported yet. If it's been a few months, you might get a talking to, but at least we haven't reported these financial statements to any external users yet, so we can make the changes. The tough part is when they are discovered in a subsequent year. So we actually have to go back, we have to make journal entries in order to show that this error happened, we reported the financial statements, we need to make a correction. And that is only if it's material, if it really makes a difference. So if it has been found in a prior year, we have to see which balance sheet accounts would be affected and make changes there. Hopefully it's just between, equipment and supplies or something really basic, and it wouldn't really matter on income. But if it did matter when it came to revenue or expenses, we need to go in and change the retained earnings account. Because remember, if it's the next year, the income and expenses have already been closed out into retained earnings. So we would need to do an adjusting entry to retained earnings in that case. So hopefully the company you work for has great internal controls and will catch any errors in the year that it happens, or maybe in the moment that it happens. But in the event that it does not get caught in that same year, you will have to do several adjusting entries. Make sure you watch the next video where we're going to start talking about comprehensive income and earnings per share.